In 2018, Indian banks were sitting on 10 lakh rupees crore of bad loans. That is larger than the GDP of most countries in the world. This is the story of how it happened and how India cleaned it up. Act 1. The Lending Boom, 2008 to 2012. The story begins in 2008. While the global financial crisis was devastating Western economies, India was a rare bright spot, growing at 8 to 9% annually. The government saw an opportunity. It launched an ambitious infrastructure push: roads, highways, power plants, ports, telecom towers. The vision was to build the foundations of a modern economy. Public sector banks were the engine. They lent aggressively to large conglomerates, infrastructure developers, steel companies, real estate groups. Loans were approved with optimism. GDP growth was masking everything. Nobody was asking hard questions. Act 2. The cracks appear, 2012 to 2015. By 2012, the picture had changed. The global commodity super cycle ended. Infrastructure projects stalled mid-construction. Power plants were built, but had no fuel supply agreements. Road projects hit land acquisition walls. Steel companies were battered by falling global prices and Chinese overcapacity. Borrowers began missing payments. But banks did not want to admit the scale of the problem. A practice called evergreening became widespread, banks quietly giving fresh loans to help borrowers repay old ones. The stress was real, but the reporting was not. By 2015, independent analysts estimated actual stressed assets were well above 10%, while the official number said just 4%. The gap between reality and the books was enormous. Act 3. The Reckoning, 2015 to 2018. In September 2015, RBI launched the Asset Quality Review. Every bank was subjected to a forensic examination. For the first time, stressed accounts had to be classified honestly. The results were immediate and brutal. The gross NPA ratio went from 4.3% to 11.46% in just 3 years. Nearly 1 rupee in every 9 lent, classified as bad. NPAs did not rise because new loans went bad. They rose because the hidden truth was finally being counted. In 2018, the Punjab National Bank fraud was exposed, 13,500 crore rupees linked to Nirav Modi. Then, infrastructure leasing and financial services, one of India's largest infrastructure conglomerates, collapsed, triggering a full-blown liquidity crisis in the shadow banking system. In 2020, Yes Bank, a private sector bank built on aggressive, under-scrutinized lending, was placed under moratorium. The RBI had to intervene. The system was under severe stress. Act 4. The Response, 2016 to 2022. The government and the RBI responded with a coordinated strategy, 4 steps, known as the 4R framework. 1. Recognize. The Asset Quality Review had already forced honest recognition. No more hiding. 2. Resolve. In May 2016, the Insolvency and Bankruptcy Code, IBC, was passed, one of India's most important economic legislations. Before IBC, a defaulter could delay resolution for 10 to 15 years. After IBC, 330 days. Creditors were now in the driver's seat. Early resolutions proved the point. Bhushan Steel went to Tata Steel. SR Steel went to ArcelorMittal. Significant value was recovered for lenders. 3. Recapitalize. Between 2017 and 2021, the government injected 3.5 lakh rupees crore into public sector banks. Capital buffers were restored. Banks could absorb losses and resume lending. 4. Reform. 27 public sector banks were consolidated into 12. Bank of Baroda absorbed Vijaya Bank and Dena Bank. PNB absorbed Oriental Bank and United Bank. Larger, More governable institutions replaced fragmented ones. Yes Bank was reconstructed, an SBI-led consortium stepped in, depositors were protected, and a bank survived. Act 5, The Recovery, 2021 to 2026. The decade of discipline began producing results, steadily, year after year. GNPA ratio, 11.46% in 2018. Down to 7.5% by 2021. Down to 5% by 2023. Down to 2.6% by September 2024. And by February 2026, provisionally 2.15%. Lower than even 2010-11 levels. Net NPAs, bad loans after provisions, fell from 6.1% to just 0.5%. Near zero. Capital adequacy rose from 12.94% to 17.36%. Scheduled commercial banks posted 4.01 lakh rupees crore in profits in FY25, the highest in history. In its December 2025 Financial Stability Report, the RBI used a specific phrase to describe Indian banking. It said the sector had transitioned from fragility to robustness. In summary, the NPA crisis was not bad luck. It was a decade of optimism, without accountability, followed by a decade of discipline, without shortcuts. By 2026, India's banking system had achieved something rare, a full institutional recovery. Cleaner books, stronger capital, record earnings. The crisis chapter is closed. What gets built on top of this foundation? That story is still being written.